If you could turn the time machine back to the beginning of 2008, knowing what you know now, what would you do different in regards to your investments? Would you look for ways to potentially reduce risk? Would you preserve more of your capital? Would you reassess the allocation of your portfolio? Does the roller coaster ride of the market impact your decision-making ability to manage your portfolio by emotions rather than objective analysis? If you answered yes to any of the questions above, then Clarus Financial Group has the solution for you. About Clarus Financial Group. Clarus Financial Group is an independent, private Atlanta-based financial services firm providing a variety of financial services, one or more which will likely meet the needs of any prospective client. Clarus Financial Group specializes in the following practice areas: investment advisory services, financial planning, retirement income planning, estate planning, business owner transitions and exit strategy solutions, 401k plans, and 401k account management. Our philosophy is simple: to help you clarify your true needs and objectives, and then offer creative solutions unique to your situation. We are a long-term professional partner in evaluating, planning, and implementing strategies to achieve your long-term goals. Here is a montage of some of the lowlights of 2008, courtesy of CNBC. If there was ever a year in which investors could have benefited from a media outlet that provided actually useful information, it was 2008. Yet we believe CNBC was then, and is now, a source of noise. The future is simply unknowable, even to the experts, CEOs, and analysts that are continuously paraded in front of the cameras. Yet each of them speaks with enough authority and conviction that millions of investors are spurred to action by their arguments. Sadly, looking back, acting on any of the information or opinions offered in these examples would have been simply disastrous. Knowing when to play offense and when to play defense can make all the difference in meeting your goals, whatever they might be. History may continue to repeat itself with steep declines in both the market and individual stocks. We feel the key is where you purchase an investment. If you invested in the stock market in 1929, it took you 25 years to get back to even. If you invested in the stock market in 1973, it took you 7.6 years to get back to even. It is the same case for individual stocks. If you bought IBM in 1987 and wrote it down, it took you 10 years to recover those losses. If you bought Cisco Systems at its high of 82, you have yet to come back to even 8 years later. After the market casualty of 2008, how long will it take you to get back to even? 7.6 years? 13 years? 25 years? Can you afford to go through another bear market? This is the 5-step process Clarus Financial Group uses to manage risk in the market. First, we look at the market to determine whether it is supporting higher prices. If it is, then we move to the sectors and determine which sectors are supporting higher prices. From there, our inventory of stocks is determined by those deemed fundamentally sound in the strong sectors. Then from that inventory, we choose those that are technically sound and controlled by demand. Finally, all the stocks in your portfolio are updated each day so that we see changes in the supply and demand relationship and can notify you to opportunities as well as potential problem areas. Each day, thousands of calculations are done to support our investment process and determine which asset classes have emerged as the leaders according to this methodology. As the asset classes fluctuate in strength, emphasized asset classes will also change, reflecting current market trends. We feel asset classes can be ranked similar to the way one might rank sports teams. If you think about your favorite sport, they rank teams based on how well they perform against their opponents. The more games, matches, or races won, the higher in ranking the team will go. We believe the same thing can be done in the investment markets. In the financial markets, a game is played each day, and it consists of comparing the daily performance of one asset class to another. Each day, we compare asset classes to one another to determine which asset classes are the strongest or weakest compared to one another. We all understand the basic law of supply and demand. We have all experienced these forces at the supermarket. We know why in the winter tomatoes don't taste very good, don't have a very long shelf life, and are expensive. We inherently understand why there are lemonade stands in the summer and hot chocolate stands in the winter. Stocks, sectors, and asset classes move in and out of favor, just like produce in the supermarket. Risk management. Clarus Financial Group's focus when managing our clients' money is to help control the risk to invested capital when investing in volatile securities and markets. Our goal is to limit the amount of downside volatility in an effort to keep clients comfortably invested within their risk tolerance. Our process aims to control risk at the individual security level and for the entire portfolio. Initial trailing stop. The stop is set at a % below the buy price. Should we buy a security and it falls immediately, triggering a stop, the position will be sold in an effort to limit losses. However, if a position moves higher in price, the initial trailing stop will adjust accordingly, trailing the security at the predetermined percentage. Should the stock fall below the trailing stop, a sell signal is triggered and the security will be sold in an effort to protect the gain. There are two beliefs about the stock market that allow us to invest independently of any single opinion or forecast that give us a winning edge. Our first belief is that markets and asset classes tend to trend for surprisingly long periods of time. I say surprisingly because they surprise most observers by how long they last, usually far longer than people think the trends should last. This tendency to trend occurs at two time frames of interest to us. The intermediate term time frame produces intermediate term trends that last for weeks to months, and the long-term time frame, which produces longer-term trends that can last for years. We think of these longer-term trends as bull markets, which are long-term trends going upwards, and bear markets, which are long-term trends going downwards. This is a chart of the S&P 500 from January 1st, 2000 through September of 2009. It shows pretty plainly that multi-year trends occur in the market, both up and down. The two shaded areas are the two bear markets that afflicted us in the last decade, as our indicators defined them, and the white area in between is the 5-year bull market from 2003 through 2007. Having the ability to identify those multi-year trends as they occur is obviously of huge importance, allowing us to adjust portfolios to take advantage of the bull markets and to seek protection from the bear markets in real time as they occur. Is it really necessary to recognize bull markets, bear markets, and immediate term trends within them? Yes. To understand why, let's take a really long-term view of the market. Here is a chart showing the progress of the Dow Jones Industrials over the last 112 years. It shows plainly that there are two distinct phases of the market. The first phase is shown by the green color. These are the bull markets that propel the market skyward by leaps and bounds. They have lasted for 5 to 17 years over the last century, averaging about 12 years in duration. Essentially, the market makes all of its forward progress during these times. The bad news is that after they end, they don't come around again for another 10 to 25 years. And those 10 to 25 year periods, shown in red on the chart, are spent going sideways or down with no net gain at all. We are currently 10 years into one of those go-nowhere red periods. We are probably not near the end of this sideways period either. We probably have another several years to go before another bull market can emerge once again. That's because bull markets can only begin when a specific condition exists, and it is nowhere near existing today. That specific condition is a very low PE ratio. It simply has to exist before a bull market can emerge. It has to exist because the majority of all the profits from one of those bull markets comes from PE ratio expansion. And until the market's PE ratio is very low, there is not enough room to expand the PE ratio. The PE ratio is the ratio of stock price, P, per share, to the company's earnings, E, per share. It is simply a measure of how much the market is willing to pay for each dollar of earnings per share. The typical bull market starts with a PE ratio down in the single digits and ends with the PE ratio way up in the 20s or 30s. In other words, at the start of a bull market, stocks are very cheap, and at the end, they are very, very expensive. For example, the PE ratio at the start of the last bull market in August of 1982 was down around 5. When it ended, it was up around 35. In other words, in August of 1982, the buyers were only willing to pay $5 for a dollar of corporate earnings. But by January 1st of 2000, buyers were willing to pay $35 for each dollar of corporate earnings. Currently, we stand at a PE ratio in the low 20s. That means that there is relatively little room to grow on the upside, yet we are more than twice as high as the usual starting point of bull markets. Belief number 2 is this: performance-based measurement can help produce the best portfolios. This means that selecting the members of portfolios can best be done by employing good, fact-based measurements of performance. High-performing candidates tend to retain their high-performance characteristics into the coming several months, and low-performing candidates tend to retain their low-performance characteristics into the coming several months. A baseball manager fills out his lineup card the same way. He puts a lineup on the field he believes has the best chance of winning, and he makes those selections based on the performance measurements he and his coaches have made in the recent past, and certainly not based on the predictions that sports writers made during spring training. Tony La Russa, all-star manager of the St. Louis Cardinals, is fond of saying at the start of every season that no one owns a spot in his starting lineup. Anyone can play their way into the lineup, and anyone can play their way out of the lineup. In other words, performance is his best indicator for awarding starting lineup positions. We feel exactly the same way about our portfolios. No positions are sacred. No positions are in portfolios because they ought to do better in the future. Any candidate can earn its way into a portfolio, and any portfolio member can underperform its way out of a portfolio. Client communication. Meetings. We customize a meeting schedule with each client that is appropriate for their individual needs. Prior to each meeting, an agenda is set. The first item on the agenda is always left open for the client's top priority. We are also prepared to hold impromptu meetings to address issues and concerns that arise suddenly. Phone calls. Staying in touch on a personal level on a consistent basis is our priority. Quarterly commentary. Each quarter, our advisors provide insight and comment on the state of the financial markets and other issues that impact our clients' financial lives. Weekly market update. This weekly email provides clients with a snapshot of the financial markets, a commentary on recent events, and thoughts on financial planning 52 weeks a year. Appreciation education events. We host client events to show our appreciation and provide information and education. Thank you for your time to learn more about Clarus Financial Group and the services we offer to our clients and the investment methodology we use to manage our clients' portfolios. The next step is easy. Please visit our website at www.clarusfinancialgroup.com to obtain your free retirement roadmap, or give us a call at 770-552-5968 to talk to one of our advisors about how Clarus Financial Group can help you. Clarus Financial Group, LLC, helping our clients understand the choices that matter. www.clarusfinancialgroup.com, 11115 House Road, Suite 100, Roswell, Georgia, 30076.